Hello, everybody, and welcome in to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and today I am very excited to welcome first-time guest Darius Dale to the show, the CEO of 42 Macro, the leading macro forecasting and market timing service on global Wall Street. We're going to discuss why he thinks that Liberation Day and its aftermath is the most transformational week in markets since the Lehman Brothers collapse. What are the implications going to be for the global economy and financial markets? We're going to talk about why he has a heavy allocation to gold and is completely out of the treasury market. Is gold supplanting T-bills as the new preferred low-risk asset? We're going to get his thoughts on the commodities sector and if he is seeing value there at present, and so much more. Strap yourselves in for my conversation with Darius Dale. Darius Dale, it is great to have you here on Commodity Culture. We were speaking a little bit before hitting record. I heard one of your interviews on Macro Voices and I was totally blown away. So I had to get you on the show. So very much appreciate you coming on. And I want to start with a recent 42 Macro presentation you gave where you said the week of Liberation Day and Trump's tariff salvo, quote, represents the most transformational week in asset markets since the Lehman Brothers bankruptcy catalyzed nearly 2 decades of fiscal and monetary policy largesse. So walk us through what you're seeing there and its implications for financial markets and the global economy.
Yeah, I appreciate you, Jesse. Thanks for having me on, man. Thanks. I appreciate you. So I'll start with chart right here, which I think is one of the more important charts of my career. And I think will go down as kind of one of the most important weeks of most people's careers in our industry. Last week, we saw a meltdown in the treasury market that was not supportive of the U.S. dollar. Traditionally, particularly in the last kind of half decade or so, the U.S. dollar has been incredibly correlated to the bond yields on the long end of the treasury curve, and then as well as spreads between bond yields on the long end of the treasury curve and other other bond markets. What happened last week was we saw actual selling and rotating out of U.S. assets. It was a real true emerging market style capital, flight story from our bond market and our currency market. And then we can clearly observe this just based on the spike that we saw in treasury yields. We peaked out in treasury yields terms at midnight or 12 minutes past midnight on Wednesday morning, 12 minutes past midnight on Wednesday morning last week. And we saw persistent selling of the dollar in both euro and British pound terms. We saw persistent selling of the dollar in Japanese yen terms. And then eventually, when we saw the second spike last week, it was persistent selling of the dollar across all major currencies: British pound, euro, Japanese yen, Chinese yuan, and Korean won. And so to me, it was an indication of the rest of the world saying, hey, President Trump, we see your trade war and we're going to raise you a capital war. And I think that this sort of that raise, that sort of check, if you will, really forced the president's hand and activated the Trump put, much like the bankruptcy of Lehman Brothers forced the Fed's hand and kind of both the Fed and Congress's hand in terms of activating what turned out to be nearly 2 decades really of fiscal and monetary policy largesse. And so going back to the implications of this, because I do think the implications are massive for asset markets, not just over the medium term, but over the long term as well. I would say the first implication of this is that it means we're probably likely to lose the trade war. And what I mean by lose the trade war is we're probably not going to facilitate this sort of global economic rebalancing that President Trump wants or is attempting to force. It may occur over or at the bare minimum, it'll occur over a much longer time horizon than what I think the administration is currently hoping for in the context of our 4-year presidential election cycle. And so ultimately, what that looks like in financial market and market response terms is, we have our 90-day pause period. They're currently negotiating trade deals with a quote 75-ish countries or whatever. We're not going to see major trade deals negotiated in 90 days, or if we do, they're probably going to be of the variety that allows President Trump and his administration to celebrate wins, but don't actually do much in terms of moving the needle, much like what we saw in his previous administration, right? We saw the phase 1 China trade deal. We saw the USMCA, and I surmise that if those things were effective, we wouldn't be here today, right? Obviously, so the ARTA deal didn't work then, and it probably is not going to work now as a function of this constraint imposed upon us by our bond and currency markets. So that's number one. Number two is the sort of implications for this sort of emerging market style crisis that we've been sort of helping our clients prepare for the past few years, a couple of years in our investing to for turning regime presentation. The one of the key takeaways from that presentation is that we're living in an era of fiscal dominance with a growing geopolitical supply demand imbalance in the treasury market. And that growing geopolitical supply demand imbalance in the treasury market requires substantial monetary debasement and financial repression to offset. And there will be pockets and times where the Fed is concerned about inflation or some other reason to not offset that enough. And ultimately, what we saw last week is a pull forward of market expectations of when they will start to offset that with substantial monetary debasement and financial repression. Number three, the third thing is that we're probably going to see an acceleration in financial repression as well. So we know the Fed can use its balance sheet to debase the currency and backstop the treasury market. That's obviously bullish for assets, maybe not necessarily in real terms, but certainly in nominal terms. The second thing is the financial repression component of that. We're probably going to see a relaxation of the SLR in a way that would force the U.S. commercial banks, further into the treasury market to provide some relief for the market. They're already floating, kind of lowering the supplementary leverage ratio, which will free up capital on banks' balance sheets to apply more, of that capital to the treasury market. Currently, if you look at commercial bank holdings of treasury and agency securities, they're currently only about 18% of total assets. When you go back to the last foreturning, some of the information that helped us, kind of program the study, we produced a couple of years ago. We were at 50% of total commercial bank assets. Treasury and agency securities were, and there were no agency securities back then. So obviously, treasury securities were 50% of commercial bank assets. They're currently 18%. So we know the number is going to go up. And one of the things that could cause the number to go up is relaxing the supplementary leverage ratio. When we get into the next emerging market style crisis in the future, they'll do something else to give banks more capital to allocate to the treasury market, and so on and so forth until this foreturning process concludes. And then the final thing
could I just jump in here for a second? Because this is the first time I've heard the term supplementary leverage ratio. Could you break down what that is exactly for us?
Yeah, that's a great question. So what the supplementary leverage ratio is, it's a regulation that forces banks to hold capital for various types of securities that they hold on their balance sheet. Obviously, with the more risky the security, the more capital you have to hold. And so one of the things that the Fed did back in March of 2020 was to temporarily, relax the supplementary leverage ratio, which freed up a tremendous amount of liquidity on bank balance sheets to allow them to buy more treasuries. Essentially, recall that we had a emerging market style blow up in the treasury market back in March of 2020 as well. So that was something that was an issue back then. And sorry, I misspoke there. It wasn't an emerging market style blow up in the treasury market. It was foreign investors liquidating treasuries because we had this worldwide pandemic and they needed liquidity. That was a little bit different than what we've observed in the regional banking crisis of the spring of 2023, of the bar shock in the treasury market in the summer and fall of 2023, and then now this. These are much more akin to emerging market style crises in our fixed income and currency markets. And so going back to the supplementary leverage ratio, one of the things that we can track to identify whether or not we're moving in the right direction as it relates to that element of financial repression is the spread between swap rates and treasury yields. Right now, swap rates are pricing much lower than treasury yields across the curve. If you look at the two-year swaps, currently today it's about 3.6, or the two-year treasury is about 3.8. If you look at the 5-year swap, it's about 3.6. The 5-year treasury is about where we at here? Almost 4%. If you look at the 10-year, it's about 3.8 versus 4.3. And then if you look at the 30-year, it's about 3.9 versus 4.8. So the further you go out on the curve, the greater the discount between swap rates, which don't require you to hold capital in your balance sheet as a bank, and treasury yields, which do require you to hold capital. If you want to own the underlying security, you need to hold capital, as opposed to having the exact same exposure in interest rate terms without that. And so, this deep spread between swap rates and treasury rates tells you that there is a dearth of capital that needs to be freed up to attack the treasury market to help banks free up more capital to allocate to treasuries. And so we expect this to come. This will be bullish for asset markets when they decide to do that. If we continue to see more blowups in the bond market as a function of the trade war going poorly, really it's a capital war. If you start as a trade war, now it's a capital war. As a function of the capital war going poorly, we know we're going to see the Fed step in and use its balance sheet to offset that. And sorry, before you interjected, which please continue to do, The final thing I'll say in terms of this, why this week was such an important week, and I would argue the most important week since Lehman Brothers, is that when you go and you look at the ownership of the U.S. Treasury market, we got ourselves into a problem here. If I can find the slide, I'm kind of stalling here. But if you go back and you look at foreign ownership of U.S. debt, we're somewhere around, let's call it 30%. Oh, here it is. Sorry, my apologies. It's somewhere around 30%. It's about 8.5 trillion of the total. 30% is gross foreign ownership. 13% is international. Foreign official ownership, so foreign central banks and their FX reserve management. If we go into a world where I would argue we're already entered this world, a world where the U.S. is no longer as complicit in the former world order in which we were playing nice from a geopolitical perspective in terms of supplying the world with military, protection for free, essentially, and a world where we are pro globalization and really really comfortable, chasing corporate profits and having the recycled trade flows and corporate profits back into our treasury market. If we're exiting that regime and entering a new regime where we're less, reliable as a trading partner, we're less friendly from a geopolitical perspective, and we're ultimately less supportive of globalization because obviously we want to reshore manufacturing capacity, then you're talking about a world where foreign investors may just be less, inclined to support the treasury market. One, they're going to have less trade flows. But two, they may just find it to be a less attractive asset. So I want investors to realize that, in the future recession, in this new world order, you may have adversaries, folks who currently own a decent amount of treasuries. China owns 3% of our treasury market, and obviously that's their official holdings. I'm sure their unofficial holdings, given the size of their foreign exchange reserves, north of $3 trillion. Their unofficial holdings have to be higher than that. We can go into a world where there's a lot of treasuries, being dumped into the marketplace from both friends and foes alike, out of this $8.5 trillion. And the reason they be dumping that into the marketplace is because they're concerned about U.S. fiscal sustainability dynamics. And I think that became kind of front and center last week.
Hey guys, just a quick break to hear from our sponsor, ARC, silver, gold, osmium, for all your precious metals needs. ARC SGO is the place to go. Owner Ian Everard is trusted and given praise even by his competitors for being one of the most honest and informative gold, silver brokers in the United States. And their special is Silver Kangaroos 2023 1-ounce coins, mint fresh for $2.47 over spot, while supplies last. Take advantage of the offer by giving him a call at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Very interesting breakdown. You mentioned the term the fourth turning a few times there. I'm wondering if you could break down exactly what you mean. Is this the classic Neil Howe, but based on that book, that idea of a fourth turning? And maybe if you could just lay out for us why do you think we are either in or entering a fourth turning, and what would those implications be both for, investors and societies at large?
Yeah, big question, but great question. So I'll start by saying, yes, I am referring to Neil Howe's fourth turning. I worked with Neil for several years, and he's a friend and a mentor of mine. One of the smartest, probably one of the two smartest people I've ever met. So if you need, I know the fourth turning has a lot of tinfoil hat connotation, but to me, it's when I review Neil's work and obviously worked very closely with him for years. He's truly, genuinely one of the best researchers in the world. If you looked at his client list, you would realize how important Neil Howe is to the world. And so that's I'll say that in support of the fourth turning. And in terms of what are we in a fourth turning? Yes, turn on the news. It's a lot of what we've been preparing our clients for over the past couple of years as it relates to this fourth turning poly crisis. And so, one of the things we did in our investing during the fourth turning regime study is sort of break the fourth turning down into its various dimensions, particularly the dimensions that have impact from an asset market perspective. We're trying to help investors safely navigate their portfolios throughout this fourth turning. Obviously, the fourth turning has political implications for people, but I'll let Neil kind of focus on that aspect of it. What we tried to do is expand upon his analysis by kind of focusing on historical fourth turnings and what they ultimately meant for the economy and asset market. So Across those four dimensions, there's sort of four main dimensions: there's fiscal policy, monetary policy, the economy, and then there's geopolitics. One of the most important takeaways from a fiscal policy standpoint is that you tend to see an explosive growth in sovereign debts and deficits as the U.S. responds to populism, and that's a lot of what we've seen since Neil would argue, we entered the fourth turning with the onset of the global financial crisis, and since then, much like what we talked about earlier, we've that catalyzed almost 2 decades of fiscal monetary largesse. Well, that was consistent with historical fourth turning episodes. There's a real demand for populism, and the populism manifests itself in a much explosive growth in the size of government. So that's kind of that's a check there. Number two, the second dimension is monetary policy. How are the monetary policy makers responding to this? Well, what we've learned since the financial crisis is that the Fed has become the lender of last resort to the treasury market. Prior to the financial crisis, the Fed's balance sheet was not a thing. We didn't talk about it. It existed, obviously, but it was, it was just, useless as talking about ladybugs in the park near your house. You know what I mean? Like it was, and now ever since the financial crisis, obviously the Fed has been forced by market forces and economic forces to use its balance sheet policy to offset, the kind of this explosive growth in sovereign debts and deficits. So that's kind of another check. Obviously, we've seen a lot of financial repression as well that has forced commercial banks, regulated commercial banks into the treasury market. We saw Dodd-Frank, we saw Basel III, we're entering Basel IV this year. So there's a lot of stuff that's happened from that perspective that's, kind of consistent with four turnings, which is the monetary policy. If the monetary authority needs to pick up the slack to help the fiscal authority, maintain and grow its size as a share of the economy. So those are two checks. The third is the economic kind of output as a function of this. Historically speaking, you tend to see higher rates of inflation in the fourth turning. Like, doesn't that sound inflationary? You're talking about fiscal dominance that's being supported by monetary largesse. that is, and you ultimately wind up, with inflation. There's a bunch of other implications as well. One of the other implications is the fact that you tend to see very aggressive financial market performance in a fourth turning. If you look at, historically speaking, if you look at the S&P specifically, for an example, or U.S. equities specifically as an example, the average annual returns tend to be actually higher during fourth turnings, but the volatility, is much higher as well. And so if you think about asset markets in a normal regime, the black line is kind of like the underlying secular trend of the market, and the blue line is kind of the business cycle fluctuations in the market, going in and out of recessions, et cetera. Well, you have a very similar dynamic in fourth turnings, but the slope of that underlying secular curve is much more steep. And you also have, as a function of that, you have much more, kind of violent business cycle type dynamics impacting asset markets. And so you ultimately have this scenario where markets go up a lot, then they go down a lot. And the up a lot is usually when the fiscal monetary largesse is, creating positive outcomes in the economy. The go down a lot is usually when the monetary policymaker is responding to inflation and, not supporting that fiscal largesse as much as fiscal dominance as much as it needs to in order to kind of sustain this secular bull. And so you ultimately have these massive fluctuations in markets. And that's exactly what we've seen. Go back to 2015. Every year since 2015, we've had a 20% rally in the market or 20% crash in the market. Every single year in the S&P 500. This is nutty stuff if you in the context of long-term market history. So that's one of the key takeaways from the economic portion as well. And there are other takeaways, by the way, but obviously that's reserved for our clients. And then finally, the last thing I'll say is the most obvious takeaway in the geopolitical section, the two most obvious takeaways rather, were a decline in globalization, like reducing trade flows, and partially as a function of that, because you're reducing economic cooperation, the world tends to wind up in total war, right? We tend to see total war as at the tail end of these four turnings. Now, I'm not forecasting a total war. Neil's not forecasting a total war either, but we have to be cognizant of the fact that the U.S. and China, which are the two biggest economic rivals in the world, who are now obviously military rivals as well, are decoupling economically. And if they decouple economically, there'll be nothing left tying us together to stop us from, stepping on each other's shoes in the club and going winding up outside in the parking lot. To borrow a reference from my former life as a poor person growing up in the hood. So, I say all that to say this is I think it's pretty obvious that we're in fourth turning. The fourth turning has significant implications from an asset market and economic perspective, obviously political as well. And then ultimately, it can be navigated safely if you're prepared for these things like our clients have been for the past couple of years.
I want to talk about what role you see gold playing, because in that presentation that I referenced at the start of the show, you mentioned that 42 macro shifted out of the treasury market late last year and heavily into gold, a move that has obviously played out well up to this point. So I'm wondering, what did you see that made you do that? And do you think gold could be, we talked about all this trouble in the treasury market. Do you think gold could replace treasury bills as the new preferred low risk asset for central banks, sovereign nations, and other large institutions? Obviously, we've already seen central bank accumulation at quite a high pace over the last few years. What are your thoughts on the role gold will play up ahead?
I love gold, man. Gold is has both offensive properties and defensive properties, and it makes it and it's generally uncorrelated, from a day to day perspective with broader, risk assets, and so it has phenomenal portfolio construction properties. It's basically, in my opinion, I think it's already replaced the long end of the treasury curve as the ballast of defense in most investors' portfolios. Not in most investor portfolios. I think it should have already placed it, and we took steps to do that back last fall when we pivoted out of the bond market. We pivoted our KISS portfolio construction, which we'll talk about later towards the end of the presentation. We pivoted that kind of systematic fixed income kind of defense exposure, the 30% of our portfolio that plays defense, from the bond market to gold. And so we obviously agree that gold is what we think it is. It's this it's replacing global capital flows that would otherwise be destined for treasuries as a form of defense or really at the bare minimum just capital preservation. And gold has now become that for a lot of investors and a lot of central banks as well. In fact, when you look at gold as a share of global FX reserves, gold is now breaking out above the euro at 21%. Off of an all-time low of about 9% back in the financial crisis. It's got a long way to go to even get near the U.S.'s 58%. It's our expectation that by the end of this decade, that 21% allocated to gold from the perspective of central bank reserves will be closer to 30%, and that 50% from currently allocated to the U.S. will be closer to 50%. So we're essentially converging towards 30, or not converging towards 30. Gold will converge towards 30. The U.S. will converge down to 50 by the end of this decade, in our opinion. That's not a explicit forecast, but that's based on the current trends and some of the development of this fourth turning poly crisis that we've been helping our clients prepare for. We think that's a very likely outcome. Gold can go much higher than that. If you go back to the early 1980s, gold peaked out as a share of global FX reserves at 77%. Now, it's not going to go to 77%. We have a very financialized paper economy globally that requires dollars to lubricate global trade and facilitate global trade and global finance. The dollar's not going anywhere in that regard. I don't think there's going to be a whole monetary reset, but what we are seeing is a monetary rejiggering, and that rejiggering requires much less exposure to the U.S. dollar and the U.S. Treasury market as a store of value, particularly in the context of what we talked about in a forward turning from an economic perspective. You tend to have much higher rates of inflation during forward turnings as a function of the fiscal monetary largesse, as well as a function of the total war that these processes tend to end in. And so ultimately, we're probably going to see, my friend Luke Roman over at Forest for the Trees, he does great work as well. He calls treasury bonds certificates of confiscation. You're going to get your money confiscated from you in real terms, maybe not in nominal terms, because it's unlike the U.S. will ever default with the Fed being able to print dollars, but you probably will get your real purchasing power confiscated from you in real terms, and ultimately gold is a great beneficiary of that from central banks and investors, both institutional and retail, who are concerned about a lot of these forward turning dynamics as they should be.
And you said you don't see a full-on monetary reset, because this has obviously been a pretty hot topic recently. Discussion of de-dollarization, the potential collapse of our current monetary system, and some new monetary system being introduced with gold involved in some way or another. It's the dream of every gold bug out there. A lot of my guests on this show talk about it a lot. There's also talk about central bank digital currencies. Are these going to play a role? Are governments going to start pushing these to gain greater control? I wonder what you see up ahead for the global monetary system. Do you think we could see the reintroduction of gold in some form or another, whether that's a BRICS gold trade system where they use gold to trade with each other, whether that's a complete gold standard, and any thoughts you might have on the potential of a central bank digital currency being introduced either, in certain countries locally or on a global scale?
Yeah, no, it's an excellent question, and I think it's already happening with the BRICS. They're settling the trade and with gold as opposed to dollars. Their bilateral trade with each other. Not completely, but certainly a lot more than they used to. In my opinion, I think this kind of splintering apart of the geopolitical world order that's being accelerated by someone who firmly believes in the fourth turning, which is President Trump. Steve Bannon read the fourth turning, said, "Hey, Mr. Trump, you should run on this." And then obviously 10 years later, we're a lot deeper in the fourth turning poly crisis. And so, this splintering part of the geopolitical world order definitely favors gold as a kind of medium of trust between nations. That's what it is. We're essentially some percentage of the medium of trust between nations is going to rotate from dollars to gold. That's exactly what's happening. It's what's been happening. It's likely to continue happening. Is it going to happen in a straight line? Is gold going to go up 2% every day? Of course not. That's ridiculous. It's going to have corrections. It's going to have significant corrections. When some of these cyclical dynamics reverse. But the structural underlying tailwind of why nations no longer trust the U.S. assets, and ultimately the U.S. dollar as much as they used to, but that's real. That's very real, and investment, we think that has tail. Going back to the big question, are we going to see a global monetary reset? We're an emphatic no on that. No offense to the gold bugs and the crypto kids, but they're like, just making up stories to support the assets you're long is not an investment strategy, right? Like that's not an investment. I don't think any of those people can tell you that there's $245 trillion worth of dollar denominated, of debt of global financial sector, non-financial sector debt globally. $250 trillion of non-financial sector debt globally. There's another, probably 100 plus trillion of financial sector debt globally. You're talking about 350 billion, trillion with a T, capital T, trillion dollars of debt. If we reset the monetary order from this to something else, what's going to happen? No, I'm asking you a question. What do you think is going to happen, Jesse?
It's going to be catastrophic, I would imagine.
What happens during chaos?
Civil unrest, global conflict, a lot of
World War III. If you crypto kids and gold bugs want a global monetary reset so your Bitcoin can go up and your gold can go up, you better be prepared to pick up a gun and fight. So I'm very serious about this. Like I don't want to mince words. Part of my job as an institutional macro risk manager is to help our clients make money across all types of market cycles and economic cycles. And we do a fantastic job of that. I've done a fantastic job of that across my career. I've been on Wall Street for 17 years. I also wear a public servant hat as someone who cares about the community and as a Christian and wants to help people. This has nothing to do with investing. If you people want a reset of the global monetary order, you need to be prepared to pick up a gun and fight, or to send your children to war, because we are going to World War III if you're talking about just completely erasing the value of $300+ trillion of global debt. One man's liability is another man's asset in a ledger-based monetary system, right? We can't just go to the Bitcoin system or the gold system without destroying the current system. And destroying the current system, you're going to have nuclear bombs in the air. We're all going to be living underground, trying to protect our families. And I don't think that's a safe, thoughtful outcome for anybody paying attention.
Yeah, great answer and great way to break it down. Any thoughts on central bank digital currencies and whether this is going to be an avenue that certain governments go down as kind of a tool of control, and perhaps a way to somehow reset their own debt personally? I mean, I don't know if that's even possible, but I wonder what your thoughts are.
Yeah, but don't forget that the currency and the currency is a medium of exchange, right? Like the asset itself, the debt will exist if we transfer to a different medium of exchange, right? And so that's something that needs to be kind of stressed in the context of this. So yes, I think central bank digital currencies are coming, right? Why wouldn't they come? They're probably going to borrow blockchain technology to facilitate that, right? We're still using SWIFT to transfer money from bank to bank around the world, right? Like that's not absurd, because there are benefits to using such outdated technology. It can't be hacked. Who the hell knows how to hack SWIFT, right? However, I do think there's probably benefits to transitioning to something that's more, productive, that also can't be hacked. You prefer something that was more productive that also can't be hacked. And so I think that's where we're going in the future. I don't know if it changes it's not going to change the dynamics that we're talking about from a fourth turning perspective. It's not going to change the decline in trust in the U.S., in U.S. assets, and ultimately the U.S. dollar. Especially from actors who want to hide their transactions from oversight.
And how are you viewing the rest of the commodities sector at the moment? Obviously, you're very bullish gold. Gold is very different from the rest of the commodity sector in that it is a monetary metal. with such a long history as money. And obviously, a lot of the things you've discussed about it ring true to me. What about silver? Has silver lost its role as a monetary metal at this point in time? Is it purely industrial now? What are your thoughts on silver, oil, base metals, uranium, and any other commodities? Do you think they could be presenting an opportunity now or potentially up ahead? What are your thoughts?
Yeah, I think so. I think secularly, yeah, absolutely. I would be long if your intent is to not touch your portfolio for the next 3 to 5 years, then yeah, absolutely. You need to have a strategic allocation to things that are going to go up when the dollar goes down. Like that to me is like such a no-brainer solution to all this is that we see outflows to the dollar and we ultimately see inflows into things that tend to be inversely correlated to dollars. Let me see if I can find that chart here. So in terms of the things that are inversely correlated to the U.S. dollar, we tend to see things like global growth for starters. That's number one, inversely correlated to the dollar. We see the outperformance of international equities. The international equities, their relative performance relative to U.S. equities is inversely correlated to the dollar. We see emerging market equities, their relative performance compared to U.S. equities is inversely correlated to the dollar. Commodity prices are inversely correlated to the dollar. And then gold has historically been inversely correlated to the dollar with the exception of the past couple of years as a function of these, geopolitically driven central bank flows. And so it's our view that we're probably going to have a sustained bear market in the dollar over the long term as the world kind of reorganizes itself from an over allocation to US dollar and US assets to a more kind of comfortable allocation to the US dollar and US assets. Don't forget this kind of US exceptionalism narrative was incredibly powerful stuff in terms of perpetuating global capital flows into the US dollar. If you think about, I want to say our net international investment deficit, it's currently right around $24 trillion. That more than doubled in the last 5 years. It more than our net international investment deficit, the US's net international investment deficit of $24 trillion, more than doubled in the last 5 years. This is a time series that goes back to the mid 70s. And so there's been this big, we always have global dollar recycling from trade flows into U.S. assets. That's been the case since we broke the Nixon broke the gold standard back in 71. And that's only gotten worse and worse over time as it relates to the hollowing out of the American manufacturing capacity, but that's a separate conversation. What has accelerated those recycling of global dollars into dollar-based assets, not just from trade flows, but also from, credit growth globally, the repo market, et cetera. There's been this giant carry trade, right? We have the best companies in the world, so you want to be along our stocks. We have the best companies in the world, so we want to be along our credits. Our interest rates, are on the sovereign curve are much higher than the rest of the world from a G10 perspective. And so you want to be along our bonds. And ultimately, although the function of all those flows, folks have been overly allocated to US dollar. It's been a one-way trade in favor of US assets and US dollar, really for 50 years, with the occasional hiccups, but specifically for the last 5 years. It's been nuts how fast our net international investment deficit has doubled in the context of that long-term time series. And so, that's a lot of capital that can just find alternatives, particularly in a world where the U.S. is no longer exceptional from an economic standpoint, because ultimately the lack of economic exceptionalism will cause our interest rates to decline. So you're not going to want to be long as many treasuries. It'll cause our short end rates to decline because you're not going to want to be long as many bills. It may not cause our long bond rates to decline. The Fed may actually have to hike rates in the future recession in the context of everything we're talking about to attract capital to the treasury market. So it may cause our short end rates to decline. So it may cause the dollar to decline as well. And those capital outflows from the stocks and credit will also, cause the dollar to decline. And so, these are the kinds of things that take years to play out. I think we very much, began that process here in 2025 as it relates to the Trump administration's kind of desire to transition the U.S. economy from what we call paradigm A to paradigm B. If you think about what paradigm A is in simple terms, it's the current status quo. The current status quo is one of globalization, globalization that sort of fed into our K-shaped economy that was sort of supported by a bloated U.S. public sector. And you can see this by this, very aggressive spread between labor and capital in the U.S. So labor down here on the lows, again, this chart starts in 1960. Labor down here on the lows at 51.5% of gross domestic income. Capital up here on the highs at about 14% of gross domestic income. There's been a significant transformation from the long run mean of these time series, which are cyclical, but now there's been a structural shift in how these time series are behaving in relation to each other. You could make the case that this sort of 500 basis point delta down and delta up in labor and capital share of gross domestic income, respectively. That 500 basis point delta is roughly about $1.5 trillion of per annum lost income from the household sector to the corporate sector, from workers to the ruling class, to the corporate executives in the form of corporate profits. And so President Trump, having identified this as far back as the kind of mid '80s, right? He's been talking about this for almost 40 years. Warren Buffett started talking about it in the mid 2000s as well. The folks understand what this is doing to the political dysfunction. It's causing a lot of political dysfunction here in the United States of America. And so ultimately, this transition from paradigm A to paradigm B, you kind of need to have a splintering of a global geopolitical world order in order to facilitate this transition. Now, separate and apart from the transition, we think that President Trump is acknowledging the fact that the U.S. is en route to losing a capital war and is essentially backing off at the pace with which he is trying to facilitate this transition. He essentially came in like the schoolyard bully saying, hey, I'm the big bad man on the block. I'm the big man on campus now. Fall in line. And the rest of the world said, not really. Your flies down, or your shoes are tied. You're untied. You know what I mean? Like, maybe that's not a great analogy. I'm not very good at analogies in the heat of the moment. But the key takeaway is that they may have to elongate this transition. I think this transition is where we're ultimately going to wind up. And if that is true, we're ultimately going to wind up with a much lower U.S. dollar and a much higher gold price, much higher price of Bitcoin, much higher price of commodities. And then finally, I'm down realizing I forgot to answer your question on silver, and I apologize for that. I would think it's very important for investors to acknowledge that gold and silver are different. Don't lump them in together. One, they're obviously mechanically different. Gold is primarily used as a store of value. Silver is primarily, or not primarily, but I want to say half of silver production is used industrially. So that's the starting point. But number two starting point is when you think about gold as it relates to defensive portfolios, silver has a beta of more than one. Gold has a beta of like 0.1 to the S&P 500. So gold has defensive characteristics and can help preserve capital during market events, market drawdowns, and severe economic, events. Whereas silver, gets sold like all the rest of the risk assets, like crypto, like et cetera, and those types of ordeals. So, there are times when they're correlated, particularly when there's accelerated monetary debasement or accelerated de-dollarization, which are essentially they're two sides of the same coin. And there are times where they're uncorrelated, kind of in market panics and economic downturns. And so I want investors to be aware that, hey, you can use silver to, kind of juice your returns if you need more to spread out your bets across your portfolio, but just know what you own and know that silver is not gold.
Well, Darius, this has been a fantastic conversation. So many insights shared. Thank you so much for coming on. Tell us about 42 Macro. You mentioned the KISS portfolio. I believe that's kind of a retail investor approach. You also help out institutions. So talk to us about what 42 Macro does, where it is, and how you can help your average retail investor out there.
Yeah, appreciate you saying that, man. So, I was cut my teeth on global Wall Street, servicing institutional investors with research like this. Built some great relationships with clients around the world. Kind of helping them navigate market cycles because the kind of dirty little secret is not a lot of people do macro well. Everyone has macro opinions, but not everyone does macro well. And so, we have a lot of great relationships, partnerships with institutional firms around the world who, have a lot of credit PMs, equity PMs, people who are really good at those aspects of institutional investing and that need a macro risk management overlay to help them. And so, I left my previous firm 4 years ago to start 42 Macro because I noticed that there was a significant gap in what we were communicating to our retail investor clients versus our institutional investor clients, and that didn't sit well with me. I wanted one, as someone who grew up on the outside looking in. I'm from Main Street. I didn't grow up on Wall Street. I didn't have a daddy in Greenwich, Connecticut, give me an internship or he'll hook me up with his friends on the golf course and give me an internship or backdoor way into finance that way. I had to earn my seat on global Wall Street. And so it's very important to me as a human being to make sure that the people who grew up like me, the people on Main Street, get to benefit from this kind of institutional grade insight as well. And so what we've done here at 42 Macro is we've built institutional grade, not only research processes to help contextualize all this stuff, but we've also built institutional grade systems to help investors kind of stay on the right side of the market risk vis-a-vis what we call our KISS portfolio construction process. That's a kind of a 60-30-10 portfolio construction solution that helps investors participate in bull markets in stocks, gold, and Bitcoin in that order, 60-30-10 in that order, and it helps them sort of risk manage drawdowns by raising cash ahead of or early into bear markets, just like it has done here in 2025. We also have what we call our discretionary risk management overlay that helps investors it applies all those same frameworks, but it helps institutional investors, kind of make factor long short bets across their portfolios in the context of our institutional grade signals. So, we're really proud of what we built here. We're helping thousands of clients around the world, many of whom are institutional investors, many of whom are retail investors. We have a very full distribution of client types, of client archetypes. And what we found is that everyone needs, sophisticated market timing, and not everyone is good at that. And so that's why 42 Macro exists.
Great. Well, I'll put a link in the description below to 42 Macro, as well as your profile on X for people who want to follow along. Thank you so much, Darius. It's been a blast, and definitely look forward to having another conversation with you in the future.
Appreciate you, Jesse. Thank you so much. We'll catch you next time.
Thank you for joining us today. This episode is brought to you by ARC, Silver, Gold, Osmium for all your precious metals needs. And to take advantage of their special right now 2023 Silver Kangaroos 1 ounce coins, mint fresh at only $2.47 over spot while supplies last, reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.